according to data from Refinitiv, we may be hitting at the bottom of the earnings trough here. And according to FactSet, the number of companies reporting positive surprises is above recent averages. Joining me now to break it all down is Michael Green, Simplify Asset Management Chief Strategist and Portfolio Manager. It's great to see you here. So let's talk about some of the moves that we've seen following earnings. So going into this season, the bar was set very low. But when it comes to tech, at least, the bar was set high, given this massive rally that we've seen since the start of the year. What's your assessment, Michael, just of the results that we've gotten this week? And it seems like it was enough here in order for this momentum to continue to the upside.
Yeah, I think the story of the quarter has largely been one that I've heard a couple of your other guests echo, which is there was a lot of concerns, there were a lot of fears, and in general, things have come in much better than expected. We've seen that in the GDP print, we've seen that in inflation data, and we're now seeing it in corporate earnings, which broadly are beating across the spectrum, with a few notable exceptions, things like electric utilities. But for the S&P 500 and for the NASDAQ in total, we're absolutely seeing relatively positive results and relatively positive reactions to those results.
So then what does that signal for growth rates here, for earnings growth in the second half of the year, then looking out into 2024?
Well, I'm not sure that it actually signals all that much for the second half of the year because we have a number of uncertainties as we look forward. If we look at the first half of the year, we saw a number of one-time positives that I think people tend to underappreciate. The first is obviously a huge increase in Social Security that led to a dramatic increases in incomes, particularly for those who are retired. The second component is that the Federal Reserve's pace of rate hikes has actually been so rapid that it has increased the interest that people are receiving on their cash balances, while it's had almost no appreciable impact on the level of interest that is being paid by the corporate or household sector. So we're just not seeing it feed through yet, except in areas like housing. And in housing, of course, we're seeing the adverse effects of that with, homes being sold hitting the lowest levels in basically history. We're actually now down below the levels of the post-global financial crisis in terms of home transactions. So those are some things I think we have to be very careful as we look at for the second half of the year. And then there's one that I think is really underappreciated, which is the state of California, which represents about 15% of federal tax collections, has an extended tax deadline until October. And that's actually contributed to a lot of the data that we're seeing in terms of the dramatic increase in federal deficit. We're seeing individual income taxes down about 20%. Again, remember, California hasn't paid yet. And so that's going to be something that hits in the second half of the year alongside student loans, et cetera. This is going to be a very interesting experience. We've never really gone through something like this where we're seeing these, very interesting dynamics. Central bank policy so far is actually bizarrely stimulative by raising cash incomes and not yet creating the restrictive interest rate conditions because nobody's had to refinance yet.
Well, Michael, when it comes to what the market at least is interpreting from the Fed, it was interesting to me when we heard from Powell earlier this week. When you take a look at the Fed fund futures right now, 80% of traders are expecting the Fed to hold steady at its next meeting. 67% expect the Fed to hold again in November. That messaging from the Fed, do you think the market is just still focused on hearing what it wants to hear and not really taking into account the fact that Powell said, hey, we are leaving the door open and we could very well see another rate hike before the end of the year?
So I actually think that the market is interpreting this correctly. My read of what Powell introduced in terms of the information was maybe a little bit different than what most people heard. I thought it was fascinating that he began in detail in response to Q&A to begin answering the question, what are the conditions required? What would it look like for the Fed to begin cutting? He outlined the dynamic of how he thinks of real rates using the Fed funds versus a forward inflation forecast. And those forward inflation forecasts have retreated so much for 2024 that if I actually look at those numbers, particularly factoring things like owner's equivalent rent, which we're starting to see come down on the shorter term metrics, things like the sticky inflation metrics coming out of the Cleveland Fed, if I exclude shelter, which has that weird OER component that was slow to react going in and is going to be slow to react coming out, that number last month, we're running at an annualized rate of less than 1% inflation on the sticky components. We may actually, and I do think we'll probably see some pressure coming from the commodity sector, in particular oil and gas, which have benefited from the SPR drawdowns. That can cause that to go up a little bit. But if I take Powell at his word, he actually just described interest rate cuts in 2024.
Let's talk about what's going on overseas here, Michael. The Bank of Japan widening its yield curve tolerance band, sending yields Across the world, higher today. This was the final central bank policy action of what has been an extremely busy week. When you take into account what's happening on a global basis, also what's happening here in the U.S., Michael, how do you think investors should be looking at this and the significance of this just in terms of the reaction that we're already seeing in the bond market here in the U.S. today, and also what it could mean for the dollar as well?
Well, I'm going to push back a little bit against that again, because if I look at what happened in the past 3 days, we had Powell testify. That led to a rally in twos, consistent with my interpretation, somewhat of a rally in tens. We then saw the strong GDP print that caused rates to rise. We then saw the Bank of Japan, the expectations that they were going to widen out the yield curve control. That certainly was realized. We've seen Japanese bond yields certainly rise. But in the United States, exactly as you're showing on the screen right now, we're actually now seeing those pull back again. And so in the course of the past 3 days, we're effectively unchanged in terms of interest rates in the United States. Again, I think that speaks to the underlying conditions that the market is looking at where the Fed is and saying, yeah, I don't think you're going that much more.
Yeah, we do have the 10-year yield back below 4%, at least for now. So, Michael, what does all this mean then for investors in terms of how they should be allocated? Where are you seeing that opportunity?
Well, listen, I actually think that what we're looking at right now in terms of the front of the yield curve, twos and in, is really an extraordinary opportunity. I think this actually plays through exactly as I was describing, where individuals who have locked in their mortgages or who have managed to cap their expenses and their interest rate sensitivity on the top side are actually looking at their income to rise significantly simply by being in riskless instruments. We're seeing this in terms of the pressure on bank deposits where money is flowing into money market funds. That to me is actually a pretty sensible trade right now, to be thinking about generating as much risk-free income as you possibly can, particularly as we look at the uncertainties that begin to develop in the back half of the calendar year. And then the last component I would just make is that some of the observations that I made at the beginning part of the year, things like the dramatic increase in Social Security. This year, Social Security rose by 9.2%, huge benefit for those who have a lot of money to invest, who tend to be older and are looking at spending off their Social Security while trying to preserve their assets. If I look at that into 2024, we're not seeing nearly that level of stimulus.
All right, Michael Green, we have to leave it there. Simplify Asset Management Chief Strategist and Portfolio Manager. Thanks so much for joining. Have a great weekend.
Thank you for having me.